Welcome to the deep dive. This is where we take stuff you're curious about, uh, grab the sources you've pointed us to, and really unpack them. Basically, it's your shortcut to getting up to speed on something interesting.
Yep. And today we're looking into a story that you flagged for us. It's from a chat with Aseem Dhru. He's the CEO of SBFC. The original source was The Barbershop with Shantanu over on YouTube.
Right. So the request was to kind of trace his journey. Yeah. From like middle class India, long stints at HDFC Bank.
Exactly. And then making this big leap, starting SBFC in his 40s.
Mm.
We also want to touch on SBFC's mission, helping those first-time borrowers here in India.
Okay, let's get into it. What really jumped out at me first was just the whole narrative. It feels familiar,
Right.
Risk, ambition, trying to build something real, especially when you're not like 22 anymore. There's always that sort of knowing nod when someone talks about pivoting mid-career. And loans, the whole middle class thing. It's relatable.
Totally relatable. And Drew himself has this very grounded view, starting with the Indian middle class. He talks about it as this group that's really feeling the pressure. You've got inflation, taxes, but still big aspirations.
Yeah.
And he made this interesting point, something for you to think about. Official inflation numbers, they don't always capture the real hit, especially things like school fees, healthcare costs.
Yeah. Those costs feel like they jump way more.
Right. He felt those everyday pressures weren't really showing up in the stats. So the key insight there for you, the listener, is spotting those unmet needs, even if they seem obvious later. He saw this huge group that the big players were just sort of missing. That's where the opportunity was.
That makes so much sense. You see the official rate, but your wallet feels different. Okay, so he spends, what, 2 decades plus at HDFC Bank? Pretty senior guy? What lit the fire then? Why jump ship after all that time?
Yeah, that's the core of it, isn't it? And for you, maybe thinking about your own career, it's a big question. After all that time in traditional banking, he just saw this massive gap. Like a huge part of the Indian economy wasn't getting the financial backing it needed.
Okay.
Get this stat he mentioned. 68 million small businesses across India. 68 million.
Wow. That's staggering.
World-leading number, but only a tiny fraction, like 8 or 9%, could actually get loans from banks or, formal institutions.
So the rest are just using informal lenders, money lenders.
Pretty much. Often much more expensive, much less reliable.
Right. And he mentioned traveling a lot for HDFC, dealing with agricultural finance. That must have given him a real boots-on-the-ground view.
Exactly that. He saw it firsthand, traveling all over. He saw the difference, between the maybe 8 core people filing income tax, and within that, a smaller group, like 1.25 crore, earning over 5 million rupees, getting maybe 40% of the loans while paying nearly half the income tax. And then just this vast majority of people and businesses who weren't really served by anyone.
The forgotten middle, he called it.
Yep. To, let's say, well off for microfinance maybe, but not fitting the traditional bank's profile, stuck in the middle.
Okay, so the need is clear. He sees it. But actually doing something about it, starting a business in your 40s, that's a different beast, isn't it? He admired the younger founders, right?
He did. He kind of reflects that back when he was starting out, these sorts of startup paths just weren't really a thing. His path was more standard. Did his CA, then sort of accidentally landed at HDFC Bank right when India's economy was opening up.
Accidental. Funny how careers happen sometimes.
Right. And he's very open about the huge influence of working under giants like Aditya Puri and Deepak Parekh. He actually compared it to learning archery from Dronacharya and Bhishma.
Slight laugh. Okay, that's quite the comparison. High praise. You'd definitely learn a thing or two.
You would. You just absorbed it, right? So he has this desire, this experience. What did he try first within the system?
Yeah. Did he try to fix it from the inside?
He did, actually. 2 main attempts. First, right inside HDFC Bank back in 2001, he pushed to set up a business banking unit for this very segment. But, the reality hit. Small loans mean you need massive volume to move the needle in a huge bank.
Slow grind.
Yeah. He even joked that Mr. Puri basically said he'd probably retire before that division got really big.
Chuckles. Ouch. But probably true from a big bank perspective.
Okay, so attempt 1 didn't quite scale. What was attempt 2?
Second try was with HDB Finance. That's HDFC Bank's MBFC, their non-banking financial company. He hoped maybe that structure would work better for scaling up these smaller loans. But again, similar issues with getting the scale he envisioned.
And that led him to realize, look, to really crack this, you probably need a dedicated company, something laser-focused. He also mentioned this sort of structural quirk in India, right, where NBFCs often borrow from banks to then lend to people the banks aren't lending to.
Yeah, that is an interesting dynamic. Seems a bit inefficient.
It can seem that way. He pointed out that historically, NBFCs popped up to fill gaps the public sector banks left open, like HDFC itself, with home loans. H.T. Perrick started that in his 60s, post-retirement.
Wow, in his 60s. Okay. So a dedicated company seems like the answer, but leaving that big corporate job. You mentioned the fear factor.
Huge factor. And think about it from, your perspective. Leaving a senior role, you lose the title, the perks, the comfort zone. Drew's really honest about it. Says he was operating more from this inner sense of fear than pure confidence.
That's refreshingly honest.
He even regretted not taking the CGAT exam years ago, purely out of fear of failing.
Man, that resonates. Fear of failure is powerful. So what was the final push? What made him actually jump at 45?
A conversation, apparently,
Yeah.
with Mr. Perrick about CSR, corporate social responsibility. Mr. Perrick's view was basically the best CSR, the best way to give back is creating jobs.
Ah, okay. That reframes things.
It really hit home for Drew. Made him see entrepreneurship not just as a business venture, but as a way to make a real impact. That, combined with this feeling of, if not now, when? And he had this long-term vision, right? Like a 20-year plan to build an institution.
20 years. That's serious long-term thinking. Okay, so the conviction is there. He needed a co-founder, right? A partner in crime.
Yep. Found one, Mahesh Dhanani, who he knew from Kotak Bank. He started having these chats, apparently at a place called Vision Cafe.
Vision Cafe, aptly named.
Apparently it was usually empty. But yeah, those late night talks solidified it. They just decided, let's do it. Let's just go for it.
Okay, decision made. Co-founder on board. Now the hard part. Getting SBFC off the ground. Financial services needs a lot of capital, right?
Yeah, big time. Their first estimate was needing something like $100 million.
$100 million for a startup.
Right. And he admits they didn't even have a proper pitch deck at the very start. Just this maybe slightly naive optimism that they could raise it.
Woofs. Gotta love the hustle. And the funding landscape in India was changing then too, wasn't it?
It was. Less reliance just on the big old corporate houses, more venture capital, more family offices coming into play. But they actually made a specific choice not to go the VC route.
Oh, why not? Seems like a standard path now.
Their reasoning was about timelines. VCs often look for quicker exits, But financial services, it needs patient money. It has cycles. He compared it to how the NBFCs backed by big corporates tended to survive the financial storms better. So for you listening, it's about finding the right kind of money for your specific business.
That's a really crucial point. Aligning your investors with your long-term goals. So they targeted family offices instead. But $100 million is still a huge ask.
Definitely. There was skepticism initially, but they kept at it. Eventually got connected with Richard Chandler. Big investor, knew the Indian finance scene well.
Okay, someone who gets it. Did that open doors?
It did. Led to an introduction to Rajiv and Emil at Warburg Pincus. Warburg was actually bidding for another company, Carval Finance, at the time. So for a moment, the idea was maybe a three-way thing. Chandler, Warburg, and Drew's team.
Sounds promising.
But they lost the bid for Carval.
Ah, man. Back to square one again.
Pretty much. Felt like it. But then a curveball. 2016, demonetization happens in India.
Right, I remember that upheaval. How did that help?
It created an opportunity. Carval Finance, the company Warburg had bid on, was now facing some distress. So Drew and his team managed to negotiate what's called a slum sale.
A slum sale? What's that?
Basically buying a distressed business, kind of lock, stock, and barrel. They acquired a portfolio from Carval, 800 crores rupees worth of assets, 50 branches, 800 employees.
Wow. So that gave them a running start.
A massive running start. Assets, people, locations, all in one go. And the name, SBFC. Apparently just a placeholder they came up with, small business finance company, and just stuck.
Tuckles. Funny how names stick sometimes. So they officially launched September 2017 with the $100 million capital and this ready-made base. Smooth sailing from there.
You'd think so, wouldn't you? But no.
Yeah.
Almost immediately, a big shock. 250 of those Carval employees they just acquired, they resigned en masse right after getting their stay-on bonuses.
Oof. That's brutal. Day one challenges.
Major setback. Drew talks about it as this huge learning experience, managing expectations, integrated different teams. For any founder listening, it's a reminder, even with money and assets, the people part is just critical.
Absolutely. So despite the capital, despite the assets, he still felt that fear, that uncertainty of being a first-time entrepreneur.
Totally. It's a different world.
Yeah.
And he really stresses the nature of lending, right? Your money goes out the door when you make the sale, the loan.
Yeah.
The revenue only trickles back in slowly through EMIs. So there's this constant underlying risk. He says it's hard to sleep peacefully.
I bet. That constant exposure. So navigating that, plus the employee exodus, building the right team around him must have been priority number one.
Absolutely critical. They didn't just take anyone. They specifically went out and handpicked experienced folks from places they knew and respected: HDFC, Bajaj, Kotak, people like Paige Podar, Naran Barazia.
Yeah.
He lists several key names. He calls them the founding team, really emphasizing that it wasn't just him.
A team effort.
And get this, they deliberately avoided recruitment agencies. Every single hire was direct, a personal connection.
Really? That's unusual. It says a lot about the culture they wanted to build from day one.
Exactly. Very intentional. And another intentional thing, profitability. From the very beginning, they pushed back hard against that typical startup idea that, oh, it's okay to lose money for years.
Right, the burn cash to grow model.
They didn't want that. They used that 800 crore loan book they acquired to actually generate revenue right away, fund their own growth, avoid those quarterly losses.
Smart, using the assets they had.
Yeah, Dhru uses this physics analogy. Force equals mass times acceleration. They had the capital, the mass.
Yeah.
But they needed the right team, the potential for acceleration to actually create the force needed to move forward.
I like that. You need both parts.
And they had to fight inertia, too. What he calls Newton's first law in business, getting a big, potentially static thing moving, plus managing friction, both external, competitors, the market.
Right.
But he stresses the internal friction is often more dangerous. Team conflicts, relationship issues.
That can sink a ship faster than anything external.
That's his warning.
Yeah.
And he even brings up thermodynamics, the second law.
Entropy in business.
Yeah. The idea that things naturally tend towards disorder, he applies it to business processes, loan approvals, customer service. If you don't actively maintain and improve them, they just get less efficient over time.
Yeah.
Entropy sets in.
So constant vigilance on efficiency makes sense in lending. Okay, let's talk about who SBFC lends to, these thin file customers.
Exactly. That underserved group he spotted way back. People with maybe not much formal credit history, financial documents might be a bit weaker, maybe more cash-based businesses. For you listening, again, it shows the opportunity in digging into segments others might ignore because they seem too risky or too hard to figure out.
But how do you figure them out? How do you assess the risk?
That's the core challenge, right?
Wow.
You have to separate the genuine need for money from the actual ability to repay it. The demand, in his terms.
Need versus demand. Okay.
Just because someone needs cash doesn't mean they can handle the loan. And Dhru makes this broader observation about maybe a lack of strong financial discipline sometimes. People taking on debt without fully understanding the implications, potentially getting trapped.
Yeah, the debt trap is real, so responsible lending is key.
Absolutely paramount. You have to provide access, but do it in a way that's sustainable for everyone.
He even questioned things like long-term home loans and car loans, didn't he?
He did raise some interesting points, like are these long commitments, locking up so much income for so long, always the smartest financial move? He talked about the trend of buying bigger, more expensive cars on EMI, this kind of consumerism fueled by loans, and how that potentially clashes with encouraging entrepreneurship, which needs capital.
It's attention, for sure.
And his idea of real wealth. It's not just money, it's freedom over your time. And big EMIs, they eat away at that freedom, right? Your salary is basically pre-spent.
That's a powerful way to put it. Time, freedom. He also had that very stark view of entrepreneurship. The chewing glass thing.
Yeah, echoing Elon Musk. He doesn't sugarcoat it. It's hard. Constant challenges. You need that deep internal drive, he says, not just following a trend.
Intrinsic motivation.
Right. And he noted how the landscape has changed. Back in the day, someone like Dhirubhai Ambani was a hero in a resource-scarce India. Now, resources, capital, maybe more available. But the competition, fierce. Longevity, he stresses, is key. Building something that lasts and taking the right capital, not just any capital that pressures you into making promises you can't keep.
Okay, so they build a foundation, get the team right, focus on profitability, then the market throws some serious punches at it.
Oh, big time. A real trial by fire. Started with the IL&FS crisis in 2018. Then DHFL collapsed. Reliance issues. Yes Bank. One after another.
A nightmare for financial services.
Absolutely. And just when they thought they were through that, bam, COVID hits.
Jeez. How did a relatively young company like SBFC survive all that, especially the liquidity crunch after IL&FS?
They managed the liquidity crisis mainly through asset securitization, basically packaging up their loans and selling them off to investors to get cash flowing again.
Okay, that kept the lights on.
And COVID Strangely, while awful, it did force them to look really hard at their loan book, identify weaker accounts faster. And crucially, the board made this call. No salary cuts, no layoffs during the pandemic.
That's huge. Builds incredible loyalty, I imagine.
Definitely. And then they did something really counterintuitive during the lockdowns.
Oh, was that?
They opened 50 new branches.
Well, everyone else was shutting down.
Exactly. They saw an opportunity, rents were cheaper, good talent was maybe available, it was bold, definitely countercyclical.
Wow. Did it pay off?
Hugely. When things started opening up after the second wave, they had this massively expanded distribution network already in place. Business just took off. They're now spread across 16 states, aiming for like 92% of India's credit demand eventually. Huge growth. But as Dhru points out, growth just brings new challenges, different problems.
Always something new. Okay, so they weathered the storms, achieved serious scale. The next step often seems to be an IPO, right? Going public.
Yeah, for a company like SBFC, professionally run, not owned by a single promoter family, it's kind of the natural path. Need more funding, better credit ratings, more visibility. Plus, regulators in India were pushing larger MBFCs towards listing anyway.
When did they decide to do it? Was there a trigger?
They aimed for a point where they hit about 10% return on equity ROE. That's a key profitability metric. It showed they were on a clear path to their target of 18% ROE. Though Dhru admits timing the market perfectly, almost impossible. The rule in finance is often, raise money when you can, not just when you desperately need it.
Take it while it's available. Good advice. Did the market conditions affect the IPO size?
Yeah, you mentioned that. At the time, the market was more driven by domestic institutions and retail investors, less by the big foreign institutional investors, the FIIs. So they sized the IPO accordingly, around 1,400 crores rupees, including a pre-IPO chunk.
And how does he view IPO success? Just the listing day pop?
No, not at all. He has this personal rule.
Yeah.
He doesn't really celebrate or call an IPO a success until the share price has held up well for a full year.
12 months. That's a much longer view than most people take. Very grounded.
Very. He mentioned their IPO price was 57 rupees. It was trading around 85, 86 when he spoke, so he expressed gratitude for that investor trust. But he also stressed, finance is risky. Inherently.
So.
His point was you can have thousands of people doing great work, but one bad decision at the top, it can unravel everything. He called the CEO the potential chief damager.
Oof, heavy responsibility.
And the cycles, right? Boom and bust are just part of financial services. Plus, rapid growth can accidentally mess with the company culture you work so hard to build. It's not just about good intentions or working hard, he says. It has to be intelligent execution.
Intelligent execution. I like that. And his own risk approach comes from his CA background, his HDFC days.
Definitely. He's big on this idea. Invert. Always invert. Before you make a move, think about everything that could go wrong.
Plan for the worst.
Sort of. Manage probabilities. Don't expect certainty. It's a bit stoic, maybe. Prepare for bad outcomes so you're not crushed if they happen. Especially in lending, he argues. Your upside is kind of capped. You get the interest back. But the downside, you could lose the whole principal, so you have to be realistic and risk-aware.
Makes total sense. Thinking about the broader picture, what were his thoughts on the startup scene in India now?
The ecosystem, generally positive. He sees lots of capital available now at different stages. That's a big change. But, he emphasizes, capital isn't enough. You still need the core.
Yeah.
A good idea, the ability to actually execute it, and just plain resilience for when things inevitably go sideways.
It's still a tough road.
And often a lonely one, he points out, even with support. And let's be real, the failure rate for startups is high. You got to be prepared for disappointment. He also thinks we don't appreciate longevity enough. Everyone wants the quick win, the fast exit. But real brands, real institutions, they take time. Sustained quality, word of mouth.
Patience is underrated.
And that clashes sometimes with investor pressure for quarterly growth, right? It can make it hard to build for the long haul. His advice to founders, be picky about whose money you take. Don't just grab anything. He also sees this shift happening in India, from family-run businesses to more professional management. That requires a different mindset, more transparency, less focus on absolute control.
Interesting transitions happening. He spoke very warmly about his mentors too, didn't he? The people who shaped him.
Immensely respectful. Deepak Parekh, he said, taught him how to build institutions for the long run and the absolute importance of doing the right thing, even when it's hard. Ethics over short-term profit.
Foundational stuff.
And Aditya Puri taught him through empowerment, trusting him, pushing him way beyond what he thought he could do, like launching consumer banking early on with zero experience in it. He also mentioned Puri's knack for seeing economic shifts coming. And Pankaj Vaish, the credit head at HDFC Dhru, credits him for basically teaching him risk management. Vaish is still an advisor at SBFC now.
Wow, keeping those connections.
Huge gratitude. And this feeling of needing to pay it forward, he says, seeing his own employees succeed, achieve their financial goals because of SBFC's growth. That brings him real joy.
The impacts, the legacy.
That's where the true satisfaction lies, he believes.
He got quite philosophical towards the end, too, about happiness and life.
He did. He quoted Jiddu Krishnamurti, "My secret is I don't mind what happens." Acceptance, maybe? Talked about different levels of experience, body, mind, intellect. Referenced the Bhagavad Gita on equanimity, staying balanced through highs and lows, sukha dukkha, gain loss.
Finding peace, basically.
Happiness as peace, an undisturbed mind, being present. He also stressed introspection, understanding your own inner junk, mentioning vipassana meditation.
Knowing yourself.
And being aware of the thoughts you consume, the mental garbage from all the information overload. Turning info into wisdom takes reflection.
How does he practice that?
His routine. Wakes up super early, 4 a.m., gets 2 hours of quiet time reading, writing, meditation, walking, guards his sleep, minimizes distractions. He shared this thought, too, that we are all alone, in a way. Our reality is an internal projection.
Deep stuff.
And how maybe some mental health struggles come from too much external focus, not enough looking inward, constant comparison, killer of joy. He emphasized gratitude.
Gratitude is key.
He found happiness really kicked in after 40. Caring less what others think, less about appearances, a kind of freedom.
Yeah, there's something liberating about that age, I think.
He told these stories about his old scooter, living in a tiny one-room place in Mumbai. Powerful motivation back then, but also a warning against always chasing the next thing. Hedonic adaptation. Find beauty now. Happiness, for him, seems tied to responsibility, impact, and that inner peace.
And that Dubai Mall story.
Yeah. Realizing happiness has 3 conditions.
Right.
It's available, you can afford it, and you don't actually want it that badly. The pleasure of being able to buy something but choosing not to. Contentment.
Wow. Okay, that's a lot to unpack. An incredible journey, really. So bringing it back to our listeners, especially someone thinking about a change, maybe starting something later on, what are the big takeaways here?
I think his story really hammers home a few things. 1, spot those underserved markets. They're often hiding in plain sight. 2, having the guts to pivot even later in your career is possible. 3, you absolutely need a great team, sound financial discipline, and just sheer resilience for the bumps.
It's not a smooth ride.
Definitely not.
Yeah.
Perseverance, focusing on the basics,
Yeah.
that's crucial. For anyone thinking about that later life jump, it's inspiring, but also very real about the challenges.
And that core piece of advice he kept coming back to, for success at any stage.
Yeah. Get really, really, really good at something. Master your craft. That's the foundation.
That feels like solid gold advice for anyone, anytime. Become excellent at something.
Absolutely. So maybe the final thought for you listening is, what are your motivations? What's your risk tolerance? And what's that something you want to get truly deeply good at? Think about the long game, the impact, not just the quick win. Definitely food for thought.